what are some of the things that you've seen that have kind of made or broken the ability for business owners to get that and have that funding approved? Because I know we have clients that you've helped through the process. So can you just talk a little bit about that?
Yeah, I think the first thing is businesses when they don't have like a good set of financial statements. So a lot of businesses, even when we look at 2020 with the round of PPP funding, a lot
Hmm.
of small businesses were not able to get PPP funding because they just didn't have financial statements. And that was one of the requirements when it came down to getting access to funding, where there were people, I have a list, I have a copy of my bank statement. It's like, no, that's not the same thing as financial statements. And
Yeah.
unfortunately, since no one was telling them the difference, they were disqualified. And I think another thing is just having a plan for the money.
Mm.
Because one of the things that I tell people is, when you show up at a bank, and this was confirmed, I had a conversation with, several commercial bankers. And one of the things that he was telling me, he said, I probably shouldn't be telling you this, but I'm gonna tell you anyway because you and I are having an off the books conversation. So I won't mention his name because his bank would probably fire him. But what I will say is, one of the things that he broke down, he said, you got to understand the economics of the bank. The
Mm.
bank's job is to sell you money in exchange for interest rates and fees. Now, if the bank is in the business of selling you money, when you show up and you give them your sob story or whatever, the bank really doesn't care. What the bank cares about is if I give you this money, are you going to be able to pay me back? Now, one of
Mm.
the things that they look at is okay, if I give you the money, what are you going to go do with the money? And are you going to do something that will allow you to increase your income to give me the security that you're going to be able to pay me back? Because if you're just going to take the money and you're just going to go, try to dig yourself out of a financial hole that you're in, for me, I'm not very confident that you're going to be able to pay me back at a later date. So the bank's probably not going to give you the money. So I would say the biggest things are, do you have financial statements? And then also, do you actually have a plan for the money?
So as far as the financial statements go, is that actual, so past financial statements as well as financial projections of where you think getting this influx of cash will put your business?
I would say it's more of the latter,
Okay.
because that's where the bank wants, and I mean, part of the bank wants to understand is what does your financial situation look like, and you're going to get that from the historical. I mean, because I mean, in reality, you can put whatever you want in your projections. Those aren't really set in stone. But a
Yeah.
lot of times, banks and financial institutions are going to go back. They want to see, okay, what do your financial statements look like? And then if they want to get even more certainty, they either require you to get an audit. If you're a really big business, they'll require you to have audited financial statements,
Hmm.
or they'll ask for a copy of your tax return because the confidence is that if you reported this income or losses on your tax return, that it's probably legit. So they're probably going to ask for the last 2 years worth of tax returns to really kind of validate the historical of where you've been. Now, if they like where you have been and they see that, hey, there's potential for you to pay us back, then they may start asking, okay, all right, what are you going to do after you get the money? That's where they may start to look at your projections.
Okay, so a lot of it is heavily focused on what your business has done in the past from a revenue, just the financial statement standpoint. Is there a specific area of the financial statements that they focus more on? Is it income statement, balance sheet, and then specifically for those statements, are there specific key things like revenue or other things that they're really paying attention to?
I mean, it's overall, if you think about it this way, because it is a little bit of a mixture and it kind of depends on what industry you're in. Because
Hmm.
overall, the bank is trying to lower their risk. The
Hmm.
bank is trying to say, okay, all right, their job is to give other people money so that they can collect interest and fees. And so their thought is if I give a person a loan that can't pay me back, I'm not going to be able to collect interest and I'm not going to be able to collect fees. So their thought is, all right, based on the nature of your business, like if you're a service-based business, they're probably going to look at your income statement because you probably won't have a ton of stuff on your balance sheet. They're going to look
Mhm.
at your income statement and say, okay, all right, do you have enough revenue and where are your expenses? Because I want to make sure you have enough profit coming into your business to be able to pay me back. Because the bank knows if I give you this loan, you're going to have to pay me, let's say $500 or $1,000 a month. They're looking at your numbers to see, can you afford to pay me that amount of money? And if you can't afford to pay me, then I'm not going to give you $1,000 because it looks too risky for me. Now, if you're a business that actually buys like equipment and or let's say you're a business that has physical inventory, what the bank may then consider is, okay, what's the value of the equipment? What's the value of the inventory? So if you don't pay me, maybe you can sell what you own to be able to pay off the gap if there's an issue that happens in your business. Or in some cases, the bank is like, hey, they'll take ownership of your physical property in exchange for the debt that you owe.